All right, ladies and gentlemen, hello. My name is Darius Anucauskas, and I'm the Chief Market Analyst here at Markets.com. And today is Monday. Ladies and gentlemen, welcome to the second week of September. Look, we have an interesting week, in my opinion. Again, another one. I mean, honestly, we cannot really say that, every week is kind of a boring one. No, since January, since the inauguration of the new president in the U.S., every week seems to be quite an interesting one. We have, of course, not only concerning that side, but in general, everything what's happening in the world. Everything seems to be all over the place right now, and there are different failures, turmoils, and bad economic data. Look, about all this and a little bit more, just in a moment. First, let's quickly have a read through our risk disclaimer. The content we produce does not constitute investment advice or investment recommendation and should not be considered as such. This material should not be taken as an invitation to acquire any financial instrument or product. Look, I wanted to pick up on the US CPIs kind of specifically because those are coming out and those are the awaited ones for this week, and I want to talk about that today. I'll try to be as quick as possible because, again, normally there is a lot to say, but you can also check out my Markets.com webinar, which I do every Monday, Wednesday, and Friday. So that's in kind of an hour-long live show, which you can always join, so feel free. Look, basically, also just a quick mentioning of our Markets.com website, which you can always check out for more information about us. If you have any questions, reach out to us. We'll be more than happy to assist. Ladies and gentlemen, economic data. Very quickly, the data that we're getting on Thursday from the U.S., of course, is the core and headline inflation numbers, both on month and year basis. And the core one is expected to remain the same at 3.1, whereas the headline year figure is expected to come out at 2.9 against the 2.7 previous. Now, we know that the core excludes food and energy. But it's interesting that the inflation here is expected to pick up on the headline number. So in a way, we can say that energy has been a little bit the factor in all this, despite actually oil dropping here. This is a monthly chart, and this is the August figure because, by the way, we're getting these CPIs that we're getting. Those are for August. Now, we did get a decline in oil prices. However, in general, things did not really get cheaper, suddenly. For example, natural gas here, we saw kind of stabilizing here a little bit in August and remaining, it did initially decline, but still remained elevated. But in general, I think that the other factors are going to kick in here. Food remains on the kind of somewhat of an expensive side. So yeah, in general, like I said, the headline is expected to come out higher. My problem here is that the number is getting closer to 3%. We know that the Federal Reserve's target is 2%. However, we're getting closer to 3%, and that's a little bit of a bummer in my opinion because we know that the Fed right now is kind of focused on dropping rates next week. The interesting thing that I was talking about last week was that let's see what kind of a percentage we will get here, because when we got the NFPs, which were a little bit of a disappointment, I would say, because last week we got the NFP number, and let me just quickly show you if you haven't seen the number. Basically, everybody's already talking about that, but non-farm payrolls, there we go, 22K against the forecasted 75K against the previous adjusted, of course, 79K. This is a disappointment. Look at this. I mean, this is what I was looking at before, and look, we are at getting closer to zero again. And this, we were back in like 2022, we were kind of thinking about like 600,000, 700, whatever is going to, what will it be? Now we're we're struggling with that kind of 100,000, and we're actually struggling. It seems like we will be struggling with the number staying in positive territory. So look, without getting too much into these details, I mean, you can check out You can check out our YouTube channel, basically where I talked about the job numbers. Because last week we got the JOLTS, ADP, we got the NFP, and yep. Also, like I said, I've produced a video for that one, so you can check us out. I think that you'll find it useful. Let me just show you what I'm talking about here. Let me just drag uh, the page here very quickly. There we go. So this is the one that I'm talking about. So you can check it out. It was a good video, good session on the job numbers where I dived into it. Look, long story short, for now, we're carefully watching the inflation number. The inflation number seems to be pushed a little bit on the side by the Fed because the Fed now cares mostly about the job numbers. At least it seems like that. In my opinion, I think that we're going to get the cut. Yes, of course, for sure. But now everybody's talking, ooh, are we going to get actually the 50 basis point cut? Look, let's not rush into things. Certainly, we can only speculate. We can only try to guess, but I keep on saying just wait for the data to come out and then we can do something about it. But at this point, let's just wait and see because look, 25 basis points, I think it's a given, and I think that this is what's going to happen. It seems like the Fed is kind of like, here you go, like to the White House, basically. Here's your rate cut, what you wanted. Leave me alone now. Let me focus on something else, right? Let me focus on inflation, which is actually already like getting a little bit out of hand here, and basically it seems like it could spiral further. Yes, job numbers are important, but lowering the rate, I don't really think that it's going to help to kind of stabilize the job market a little bit. Maybe by a little bit, maybe we could see that number jumping back back above 100,000. But it seems like at the moment it's like a distant reality, right? So now, like I said, the focus is going to be on the CPIs on Thursday. Those are, like I said, those are expected to kind of either stay the same or come out on the higher side. So not very good. I don't know, like I said, how can you support the rate cuts, but hey, for now, I think, like I said, the job market is the more important one. Look, another piece of inflation metrics, which is coming out from the U.S. on Wednesday, the day before the CPIs. Now that's going to be the PPI. So the PPI, the month-on-month, is expected to decline. The year-on-year figure is expected to remain the same. And talking about the headline, the core is expected to decline as well. Now, it's interesting. It's very interesting that we're seeing a little bit of an opposite direction here. So let me just open up the chart. So the headline is expected to remain kind of somewhat flat. Where's the CPI? Where's that CPI? Where is that CPI? There we go. So initial inflation rate. There we go. Launch the chart. With this one, it is trying to make its way back up. And look, I said it before in one of my videos that if you would ask me to apply technical analysis on this, I mean, I've talked about such patterns before. Whenever you see a sharp decline, then a gradual decline, then basically you end up with a nice shot to the upside. And yes, the US PPIs are on an incline here. However, I think I see more threat in this rather than in this. This is kind of stable, because these guys can always pass on the costs to the consumer. And at the moment, the costs have not been passed as much, but up to what level you can drag this. I mean, I think that there could be, let's say, companies might be getting some sort of leeway, some sort of support from the government, and or maybe they're deciding, they decided not to absorb the, or no, sorry, not to spread the their costs onto the consumer, just absorb instead. And that's where maybe it's keeping the CPI under control. Maybe, like I said, maybe the government has something like encouragement to the businesses, saying, hey guys, if you don't pass on the costs, we will give you et cetera, or something like that. So some sort of tax credits or whatever. Again, something has to be said and done in order to justify the fact that the costs are not passed on to the consumer yet. So again, we're this is just me, like I said, thinking out loud here. Let's see, of course, how this plays out. But certainly, the CPI is the one of those that we're going to be watching very carefully. At least the market participants are going to be watching. The Fed is watching, but probably not making too much emphasis on it at this point, at this time in our lives. Anyway, so yeah, let's keep an eye on that one. How the way it could play out in the market. Now, first of all, I want to pick up on gold here. Gold is exploding nicely to the upside today. Look, gold right now is seen as a safe haven. Everybody's into gold. It seems like the market is fearful. It seems like the market is trying to park their money somewhere safe, because the US dollar here is on the verge of breaking lower, although it should also be seen as a safe haven. However, we understand that right now the US dollar is not the one that kind of stores value, because again we understand that despite inflation kind of slowly ticking up, dollar remains on the lower side, and it's mainly reacting to those cuts that there are going to be cuts. And I think that, look, before the interest rate decision, I think the dollar could still drag to the downside, because everybody's now expecting a 50 basis point cut. Sorry, not everybody, but just the market is now like talking about a potential 50 basis points, and we see those other analysts who are supporting this idea, justifying that, and maybe that's what's raising that fear. And of course, look, for now it plays out wonderfully for the U.S. Government, because again they want the U.S. dollar a little bit on the cheaper side. Again, we understand why, because you make your exports a little bit more attractive, and when your exports are mainly weapons, that's like that's good, because then it becomes better for the foreign buyers to to purchase your goods. So yes, and we're seeing this tendency, and I think that the U.S. dollar could remain to the downside for now, at least, unless something changes with the Fed. So imagine this, up until the 17th of September, we could be seeing the US dollar kind of on a move lower, but then the Fed comes out with only one rate cut of 25 basis points. Then the market basically reverses. The US dollar could reverse back up, basically because at the moment maybe the fear here is kicking in from the fact that there could be potentially two rate cuts. So yeah, and inflation, of course, that matters. And if inflation kind of pushes strongly to the upside, maybe it's not going to allow the dollar to fall off the cliff that hard, and maybe it's gonna just keep it somewhat afloat, So if inflation suddenly drops, yep, I think that we could see the US dollar here, actually dropping even lower. So again, like I said, do not try not to over speculate this one. Try wait for the data, and then we could see what could happen next. But like I said, if inflation does come out on the lower side from in the U.S., the PPIs and CPIs, then yes, we could see the U.S. dollar drifting lower, and again fueled by potential two rate cuts, which I don't know. And I think, like I said, then next week the central bank comes out with one cut, and it kind of helps the US dollar to rebound. So like I said, this is just a scenario in my head. Again, let's see what's going to happen. Certainly there's a lot of factors that that could play into here, and certainly let's keep an eye. Actually, let's have a look at the US indices. Those are near their highs, and S&P is at all-time high, created one on Friday. Dow Jones did try to go for a new all-time high on the, actually they did. Yeah, it did. Sorry, it cleared on the cash index, by the way. So it cleared the previous and created a new all-time high on Friday. And basically, who's left? Nasdaq. Nasdaq is left with not hitting the all-time high yet. So I kind of stick to the theory where eventually all those three top in the U.S. indices kind of eventually go for the all-time high. They all three of them hit and then reverse back down. So then you get some sort of like a correction back down. But first, they all need to hit the all-time high. But again, that's theory. Don't it's something that from the observation from all those recent all-time highs that we've hit on the U.S. indices. In terms of the currencies, very quickly, Euro USD, I just wanted to pick up on that one. Look, I mean, at the moment we're breaking the downside line, and if I'm expecting the US dollar to remain a little bit on the downside, then yes, at the moment it's a clear thing here that we could, travel towards the current highest point of this year near the 1.1830 zone. And if that gets cleared, well, a new high for this year could be established. So keep that in mind. Ladies and gentlemen, let me know in the comments what you think. I mean, I hope you found it useful. Thank you very much for watching and listening. As always, stay safe. Have your stop losses in place. Risk only what you can afford to lose. Don't overtrade and everything fine. Don't forget to like and subscribe to our channel in order not to miss any of these upcoming little takes on the economy. Thank you very much, and I'll see you later. Bye-bye.